What if I told you that most of the money in the world isn't actually printed? It's just typed into existence on a computer. It's a mind-blowing concept, but it's the reality of our modern economy. We all have this image of giant printing presses churning out endless stacks of cash, right? But the truth is, that's a tiny, almost insignificant part of the story. In fact, that physical money you can hold in your hand, the notes and coins makes up only about 5% to 10% of the total money supply in most developed economies. So, where is the other 90%? It exists as digital entries in bank computer systems. Just numbers on a screen. So, if it's not being printed, how is all this new money created? It happens in two main ways. First, commercial banks, like the one you use every day, create new money out of thin air every time they issue a loan. When you get a mortgage for a house, the bank doesn't take someone else's savings and give it to you. They simply create a new digital deposit in your account, and poof, new money exists. The second and more powerful way involves the central bank, like the Federal Reserve in the US. They can create new digital money to buy things, usually government bonds, from commercial banks. This process is called quantitative easing, or QE. The central bank clicks a button, credits the commercial bank's accounts with brand new digital dollars, and in exchange takes the bonds onto its own balance sheet. This injects massive amounts of new money into the financial system, encouraging banks to lend more. Now, why should any of this matter to you? Two words: inflation and stability. When the central bank and commercial banks create a lot of new digital money, the total supply of money in the economy increases. If the amount of goods and services stays the same, but there's more money chasing them, what happens? Prices go up. That's inflation. Your dollar buys less tomorrow than it did today. That feeling of your grocery bill getting higher and higher. This digital money creation is a major driver behind it. It silently eats away at the value of your savings. But there's also a hidden risk that works in the opposite direction. The system relies on confidence and continuous lending. If people get scared, say, during an economic downturn, TAN stop borrowing, and banks get nervous and stop lending, the money creation process slams into reverse. Loans get paid down and not replaced with new ones, and the money supply actually shrinks. This is called a credit crunch, and it can starve the economy of the money it needs to function, leading to recessions or even a full-blown financial crisis. It's a delicate balancing act. So, the next time you hear a politician or a news anchor talk about printing money, remember what's really happening. It's not about paper and ink. It's about digital keystrokes creating and destroying trillions of dollars within a complex global system. Understanding this is the first step to understanding how your own money is affected. If you want a deeper dive into how inflation specifically targets and reduces your savings over time, let me know in the comments below. Thanks so much for watching. If you found this breakdown helpful, don't forget to hit that like button and subscribe for more videos that demystify the world of finance. See ya in the next one!